Well, good morning, options traders, and happy Friday, everyone. Well, I've got a question for the group. Who would like some free options? That's right. Options. Don't have to pay a thing for them. Sounds like it'd be a pretty good deal, doesn't it? I think everybody would want to jump on it. Well, you've probably heard if it sounds too good to be true, it probably is, except in this case. It is true. There is a way to get free options. And unfortunately, many of you are the ones that are providing them. So how is it that you could be giving away free options to the market? Well, this actually happens when you are using limit orders. And the reason is that limit orders guarantee the price, but they don't guarantee the execution. And I talked about this with limit orders in the trading fees and rebates video. So if you're getting trading rebates, you do it through limit orders. And this is another reason that traders think that limit orders are the only way to trade. They guarantee your price, you're not going to get any surprises, you might even get some trading rebates, and they say, therefore, the only thing that I use is a limit order. But when you're doing that, you are providing free options for other traders. Now, what I'm about to show you here is really just a different way of thinking about it. It's a different framework for understanding the quotes, but it can add some interesting insights about the risks that you might be taking. So for starters, let's say that this is the quote, maybe on an option, we have a bid 5 offered at 550. And let's say that this is your asking price at 550. It's an obligation to sell. That's what a limit order is. So you are now the lowest seller, lowest price at which somebody's willing to sell, and that's why your price is being displayed to the entire market. But I'm sitting here watching the markets and a very big piece of news drops in, maybe this company's getting bought out. And I say, wow, that option should be trading for 10 or 15 bucks. Well, guess what? You didn't have time to change that order. So another trader, somebody else could come in here and say, all I have to do is place an order to buy at market. And when they do that, you have an obligation to sell. Sounds like a call option, doesn't it? If you sell a call option, you have the obligation to sell, but for that, you get paid a fee. And here, for placing an asking price, you got paid nothing. You just left this quote, fixed price, out there for nothing. Conversely, let's say that maybe this is your bid at $5. If you're the high bidder, it means you are the one person in the market who's willing to pay the most at that moment. But that price doesn't change unless you go in and change it. But while that order's floating out there, it stays fixed. So if some big news hits the market that now says that this stock is going to be worth a lot less, another trader could come in here, sell at market, and they are going to get matched with your bid, and you have the obligation to buy. Much like if you sold a put option. If you sell a put option, you have the obligation to buy, but you receive money for it. Here, you stood by ready, willing, and able to buy an option, and you receive nothing. So the risk of limit orders is that the limit orders aren't reflecting new information. And traders and algos can pick off those orders upon the arrival of favorable information. And this is why limit orders technically are providing free options to other traders. Now what's interesting is that this framework can also shed some light on what happens when volatility increases. So think about this. If you're selling calls or puts, and volatility increases, how would you adjust your strikes? Well, let's start with the bid. This would be similar to selling puts because you've got an obligation to buy. If you're selling puts and the market's getting riskier, you're probably going to start selling lower strike puts. In other words, you're probably going to start shading your bids lower to account for that risk. What if you were the asking price here at 550? We just saw that this is similar to having the obligation to sell, like a short call. And if you were selling calls in a volatile market, what would you do? Probably start selling higher strike calls. You would start shading those strike prices higher, and the markets will do the same thing. They will start moving those asking prices higher. So what do you notice that happened? The bid-ask spreads widened. And so this is another way of understanding why the bid-ask spreads widen during high volatility. And it's because the traders who are placing these limit orders are really providing free options to the rest of the market. So be careful how you place your limits. If you'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course and strategy lab at optionsatoz.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.